Goldman Sachs says the S&P 500 will deliver an annualized return of just 3% over the next decade. Are they right? Over the past 37 years, the S&P 500 Total Return Index, which includes reinvestment of dividends, has returned about an 11% compound annual growth rate, while over the past decade, according to Goldman Sachs, it has returned 13% annualized. In their global strategy paper, Goldman Sachs says that over the next 10 years, the S&P 500 will deliver an annualized return of just 3%. What is Goldman seeing that leads them to make such a dramatic and risky claim? Their thesis is simple. So much of the S&P 500 is concentrated in the largest 6 or 7 stocks, and over the last decade, the S&P 500 has delivered better than average annualized returns of 13%. So their wisdom is that it has to return to the mean. They also think the economy will contract soon instead of expanding. And for some reason, they're forecasting that the yield on 10-year treasuries will stay high at 4% or more. Here's where I think they're wrong. First of all, yes, the S&P 500 is a market capitalization weighted index. So you can see here that Apple makes up 7.14% of the index, NVIDIA 7%, Microsoft 6%, and so on. And you can see very quickly we get down to less than 1% for each component of the S&P 500. And those top 6 or 7 stocks have really increased their influence over the past couple of years. But that doesn't mean other lower market capitalization stocks can't grow even larger and cause the S&P 500 to go up more than Goldman anticipates. And there's also nothing saying that some of these top stocks here can't continue to grow just because they've grown a lot over the past several years. We're living through an unprecedented time of innovation, S-curves, and productivity increases. The Fed will need to lower rates faster than most people see coming because inflation will not only fall, but could become negative over the next year or two. You can bet the Fed fears deflation much more than they fear inflation. We're entering a unique time in history that most people, and even the Wall Street analysts, don't see coming. We're entering a time of huge, unfathomable productivity gains, reductions in cost of living, abundant, cheap, and clean energy, efficient and much less destructive food production, and major leaps forward in the treatment of disease. And most people, even those who are paid handsomely to look ahead, don't see it coming. I've linked several Tony Seba videos in the pinned comments below. Please take the time to watch them if you haven't already. It'll really open your eyes. So why do I think Goldman Sachs is wrong about the next decade? Well, for one, I see at least one company poised to achieve well over $1 trillion in revenue in the next 5 to 10 years. Yes, I said $1 trillion. Think about that. The largest company, Apple, has annual revenue of less than $400 billion. Currently, this potential $1 trillion in revenue company is not even in the top 7 stocks of the S&P 500. That kind of phenomenal growth will push the index higher even if the other 7 stocks are stagnant, and I doubt they'll remain stagnant. In addition, I see inflation coming down, as I mentioned earlier, dramatically over the next 5 years, which will keep yields down on the 10-year Treasury note. This will make stocks even more attractive going forward. And why are stocks more attractive when the yields are lower on Treasuries? Well, 2 reasons. 1, the cost of capital is lower to companies, and 2, there's not much competition from the yields on bonds to give you safer and better returns than you can get on stocks. So is Goldman Sachs correct in their prediction that the S&P 500 will have annualized returns of just 3% over the next 10 years? What do you think? I'd love to hear from you on this topic, but I can tell you one thing. I'll likely be roasting Goldman every year over the next 10 years for making this very risky prediction. With all of that, let's go through the current health of the stock, bond, gold, and crypto markets. Well, if we take a look back over the past week, the last 5 trading days, you can see the markets are really struggling to get any sense of direction here. And why is this? Well, we're not that far off from the presidential elections, and I really think the markets are just going to tread water until we get past that event. And you can see that over the past month. They've kind of dipped a bit, gone up, and, kind of gone nowhere. Up, slightly down, and nowhere. And then if we look back over the past year, you can see we still have a very healthy appetite for equity risk. Now, ARK Invest is not on the top, but it's heading higher very quickly here. The NASDAQ 100 is up here on the top, followed by the S&P, followed by small caps, and then followed by the Dow. This is a very healthy relationship for equity risk. And what about the current bottom dynamics? Well, if we look at the bottom dynamics, you can see exactly what I was talking about. The markets have been just kind of slowly drifting higher in a very tentative way. And you can see that the confidence level, this dashed black line, has been relatively low, especially as we get closer to the elections. Now, it did come back up here to 80%, which is fairly high, but you can see that it's pulled back again and is below 80%. And the bottom forming indicator, the solid orange line, has been all over the map. The bottom confirmation signal, the solid blue line, all over the map. So really no leadership and no direction, just kind of drifting higher. And how does that show up in risk versus opportunity? Well, again, all over the map. You can see that risk acceleration, which is the key indicator that I look at, was up here above 60 and 70, which is really scary for me. But then you can see it dropped below 60, really plummeted back here in the last couple of weeks, and then has started shooting higher again. So it's above 60 again. So it appears as we're getting closer to the election, the risk indicator is moving higher. Now, what else are we looking at? Well, opportunity acceleration, this purple line, has been moving steadily higher up until recently, and now it's starting to fall. Risk, the red line, which is a very laggy indicator, is now moving higher. That's not good. And opportunity, which is also a very laggy indicator, is also moving higher, but is kind of flat-topped here. So again, a very mixed, somewhat tentative picture when you look at these risk metrics. Now let's take a look at equity versus safety. Well, this is interesting. Let's jump right into the overlays. You can see that we had a very nice rally here, I guess I'll call it, in equities. The NASDAQ 100 moved right up to first place, S&P 500 Dow, while small caps were down here. But you can see since that time, things have kind of jumbled up here a little bit. Small caps have moved up very nicely into fourth place. We have NASDAQ 100 in third, S&P 500 in second. Now, I like the fact that the Dow has fallen back from first to sixth place. Why? These are equities. Shouldn't they be going up? Well, yeah, they're safer equities, though. So the fact that they're trailing behind riskier equity baskets like these gives me some hope. And I like the fact that cash has stayed flat. Now, what's happened recently? Gold has moved up from sixth all the way to first. Gold and the Dow have switched places, partially because gold pushed higher and partially because the Dow hasn't been performing as well lately. And what about safe haven assets? Well, you can see that gold has pushed higher dramatically here. Cash stayed flat, and then everything else stayed flat. And by the way, you really don't want to see the long duration treasuries ranked lower than the shorter duration treasuries. This is not a healthy appetite for treasury risk. And we know this because yields have been going higher at the long end, causing these to drop. And how does all of this show up in the buying and selling pressure? Well, first of all, you can see that the Dow has pulled back here, which correlates with what we saw in equity versus safety and how it dropped back. And you can see that since back here, in fact, let's jump into the overlays. Since back here, the buying pressure has been declining while the price has been moving higher. And if you look at what happened, eventually that has to give, and it did. The price of the Dow started dropping. What about the S&P 500? Well, price sort of wandering higher, hasn't pulled back dramatically like the Dow, but you can see that the buying pressure is also declining here. It's a little tough to tell because it's not doing much of anything, and the selling pressure is increasing. So it appears as we get closer to the election, the markets are starting to take risk off. Now, in the case of the NASDAQ 100, again, rising price, falling buying pressure. And in case of IWM, rising price until recently, and just like the Dow, falling price, with the selling pressure, the solid orange line, moving up dramatically. And you can see that. Now, these don't go up to the present. These are from at least a week ago. But you can see what was happening. We've got these divergences, rising price, falling buying pressure, rising price, falling buying pressure. That can't continue forever. And the result is you end up with falling prices. What about ARK Innovation? Well, very similar picture. You can see here the buying pressure, the solid gray line, has been trailing off as the selling pressure, the solid orange line, has been generally moving higher. Now, ARK Invest has been kind of waffling sideways and really not going anywhere since back here. Now let's take a look at sector rankings. And if you've watched my previous videos, you'll know that these are extremely laggy. They move very, very slowly. So they tend to give you kind of more of a picture in the rearview mirror than where we are or where we're headed. So let's jump right into sector rank acceleration because these move more quickly and give you more of a sense of where we are and where we might be moving toward. So what is there to like here? Well, there's a fair amount. You can see consumer discretionary moved up. You can see that technology, XLK, moved quite a bit higher. ARK Innovation moved higher in the rankings. The NASDAQ 100 moved up nicely in the rankings. The semiconductor index moved up one notch. And the Dow Jones Industrial Average moved down, as we know. Now, this is a brown line because these are equities, so the fact that they moved down could be considered bad, but they're safer equities, so the fact that they're moving down can be seen as good. So red and green makes brown. And the same is true for consumer staples, safer stocks. The fact that they're moving down is okay with me in this context. And then small caps also moved higher in the rankings. So what doesn't look good? Well, there's a fair amount here that doesn't look good. And this plays right into what I said earlier about the markets being very tentative and directionless until after the presidential election. You've got emerging markets moving quite a bit lower. You've got the NASDAQ 100 moving lower. You've got the S&P 500 moving lower. You've got gold shooting higher into first place, and this could have been a reaction to the tensions in the Middle East. And in fact, that links up very nicely with aerospace being up here in first place, but you can see that aerospace plummeted way from first place all the way down to the bottom quarter of this table. We have cash moving up, which is not good. So, and then Bitcoin fell back a couple of notches. So there's a lot not to like, and there's a lot to like. It seems like an even balance here between good and bad. Now let's take a look at treasuries, and you can see a very similar picture to equities. You can see that these have gone nowhere to down. They've been under more pressure because yields have risen at the longer end where the market controls them. What if we look back over the past month? Again, an unhealthy appetite for treasury risk. And then if we take a look over the past year, we have a healthy appetite for treasury risk. I think after this huge drop that this will start to resolve, and long duration treasuries could end up being a real bargain here. And how does this show up in the buying and selling pressure? Well, you can see exactly what I was talking about. The prices have fallen in every single case here, regardless of duration. And you can see, just like equities, the buying pressure, which peaked out back here, has fallen dramatically. Now, it was falling while the prices were going up, which is a divergence, and that indicates that the price can't continue going up, and it's either the price is going to have to turn down or the buying pressure is going to have to turn up. And, well, you can see what happened in all cases here. All of them are lower. And you can see the divergences here. But where are we now? Well, now we have, at the longer end, we have falling prices and falling selling pressure. This is a divergence that leans toward these turning around and moving higher. You can't have the selling pressure continually collapsing while the price declines, because eventually the buying pressure takes over and these will move higher. So one of two things has to happen. And if I were going to bet, I'd say that these are going to move higher fairly soon, possibly right after the election. But you can't have buying pressure increasing and price dropping. Either the buying pressure has to collapse and selling pressure has to go up, or the price has got to start to go up. One of those two things has to happen. Now let's take a look at the yield curve. And notice I'm not saying inverted yield curve. We're currently almost 13 basis points uninverted, which is good. We want to see that continue moving up. But we don't want to see that moving up because yields at the 10-year are moving higher, which they have been lately. This blue line is current. The red line is 1 month ago. So you can see the yields have moved up fairly dramatically here in the past month. What we want to see and what will happen is, as the Fed lowers rates, where they control things down here at the short end, these are going to come down dramatically, and these should also fall with them, but not as much. So this curve will become even more uninverted, and this spread will increase. So what do the markets think the Fed's going to do when they meet just a little over a week from now? 1 week, 4 days, 4 hours, and 41 minutes from now. Well, you can see the market's pretty locked in on the fact that the Fed's going to lower rates by 0.25%. The blue line is where rates are right now, and that's when they meet on November 7th, right after the election, interestingly enough. Now, on December 18th, in December, the markets think that the Fed will have lowered rates by 0.5% by then. And if we go out to January, you can see we're at 0.75% rate reduction. So this is very encouraging and should bode well for long-duration treasuries going forward. And what about gold? Well, you can see, just as we saw in equity versus safety, gold has been moving aggressively higher. But, and here's the but, you can see the buying pressure really peaked out here at a fairly high level and has just collapsed since then, while the selling pressure is moving higher. But what's happening to the price? The price has been moving higher. This is not sustainable. If I were a gambling man, I'd be shorting gold right now. And what about Bitcoin? Well, you see a similar situation here. With Bitcoin, we had a peak in the buying pressure here, which, by the way, we also had a very big peak back here. And what happened after this collapsed and the price continued moving higher? The price fell. In fact, I think somewhere back here or back here, I said if I were a gambling man, I'd be shorting Bitcoin right now. And it would have worked out. You can see the price collapsed as this price moved higher, and then the price fell, which makes sense. Now, what's happening now? Well, the selling pressure appears to have peaked, at least briefly here, and it's moving lower, but the price is moving lower. So what's happening now? Well, the price is falling and the selling pressure is falling while the buying pressure is starting to increase. If this continues, this price should turn around and move higher. As you can see from the price movements and metrics for equities, the equity markets and treasuries are treading water or moving lower until we're past the election coming up in just 10 days. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance, rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next time, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.